Welcome back to Financial Clarity for Doctors, everyone. Thanks for joining us today. This is Rachelle Vanderzanden here, as always, with Corey Janoff.
I'm here too.
Yes, you are. Today, we wanted to walk through a few common questions that we often get from clients in meetings. We do a lot of deep dives into specific topics, and some of these questions you can hear, like that deep dive version, somewhere else, like in a different episode. But we thought it would be helpful to have a whole bunch of common questions all in one place because sometimes it's easier just to get a little snippet of things. Um, Chances are, if multiple people have asked us, like there's lots of people that have those same questions. So we thought it could be useful to go through a few of them. And there's a good chance lots of people are curious about it. So if you want to add something to a conversation like this, always feel free to send us your questions. But we're going to get into a few things on investing and insurances and all sorts of financial planning topics today.
Yes, I think probably the most common question I get, and I've probably gotten at least weekly for the last 15 years, and I'm sure you have too, Rachelle, is now a good
Mhm.
time to invest? Like, I saw so and so headline, this and this is happening in the world, politics, election, whatever. Is now a good time to invest? Stock market's down, stock market's up. Should I invest at a high or a low? Is it going to keep going down? Is it going to keep going up? Um, As with all of these questions, Rochelle and I's favorite answer, it depends. What are we investing for? When do you need the money back? The short version answer is if this is long-term money, like we're earmarking it for retirement, we're not touching it for 15, 20, 30 plus years, then it's always a good time to invest. Yes, invest. If the stock market isn't higher 30 years from now, we probably have bigger problems at hand. So yeah, invest. You can't control the markets, can't control taxes, inflation, interest rates, politics, whatever. But as long as there's people on this planet, we need to eat, we need to buy things. Therefore, there's opportunities for companies to deliver goods and services to people, and therefore opportunities for investors like yourselves in those companies to benefit in the long run. Now, if it's short term money that you need soon, that's where we want to maybe be a little more conservative. Maybe don't invest in stocks or anything else that could go down in value. Maybe stick to conservative bonds, treasuries, CDs. Right now, you can get a pretty decent interest rate in your high interest savings account. So if it's just money for the next 1 or 2 years that you're going to need for a home down payment or whatever, probably just keep it in cash or short term treasuries is the easiest. Call it a day.
Yep. I think it all depends on that time horizon. That's what it depends on. Another question we get a lot is the difference like, should I be investing more? Should I be trying to pay off my mortgage faster? Like, how do I decide which of those two things is the better move for me? And we covered this one in depth a few episodes ago, and also this depends too. I think the biggest question that you need to answer for yourself is what the interest rate is on your mortgage. So if you have a 2 or 3% mortgage, that's how much they're charging you to have that home loan. And that's not a lot. Like the interest rate that you're paying on your mortgage is just not a lot. And also, it's potentially tax deductible. So, a lot of times when we're thinking about the trade offs between investing and debt repayment, we look at the interest rate as a good number to kind of decide like, is this like effective, efficient, and also worth my extra money? And you kind of compare it to what you may expect to get on investments long term. So investment returns are not predictable, but over a long enough period of time, we kind of hope that we're going to get 7 to 10% or something in that ballpark. So if you can get a 7 to 10% return on a long-term investment by investing money, and you can get like a 3% return by putting extra money towards your debt, is that really worthwhile? Like maybe we should just be investing that extra money instead of putting extra money towards our mortgage. That being said, like if you're in a position where your mortgage interest is much higher, it could be a lot more attractive to start putting more money towards that mortgage. But again, because that mortgage interest is potentially tax deductible, like the actual interest rate that's stated on your mortgage may not be the effective interest rate that you're paying. So keep that in mind as well. If you feel like you're very on track with your long-term savings and like retirement goals, like you are saving and maxing out your 401k, you're putting aside at least 20% of your gross income towards all of these long-term goals, all your projections say like we're on track for retirement, and it will like make you feel more secure to put more money towards your mortgage. That's still a good use of money. Even if it's not the best rate of return that you can potentially get, paying down debt is a good use of your money. So don't feel like you can't do it or like we're telling you never, ever, ever do that. The other thing that we can say about investing versus paying off debt is investing has risk inherently, like it has risk. Paying off debt doesn't have that same kind of risk. Like when you are paying off debt, you know exactly what you're getting for doing that. You know that rate of return because it's basically the interest rate that you're paying. So lots of trade-offs to think about, but generally speaking, if the mortgage interest rate's really low, probably not worthwhile. If it's higher and higher and higher, much more worthwhile considering.
Yep, yep. Let's see. Should I make changes to my portfolio or investment strategy given insert news headline, event, political topic here, election, what's happening with the government,
Geopolitical
stuff,
risk, whatever.
COVID, bird flu, whatever. Um,
Inflation. Yeah.
I mean, alternative versions of this question. Should we hold off on adding more money to our portfolio given blah? Should we invest in treasuries instead of stocks right now? Should we focus on paying down debt instead of investing because of blank? I mean, this all gets back to timing the market, which is impossible to do consistently with success. And I think one of my favorite quotes out there is the US Congress has been a dysfunctional swamp of disappointment since 1776, yet US stocks have done well ever since. So true. I mean, right now we're sitting at an all time high in the stock market, and you could argue, at least in our lifetimes, it seems like the most political turmoil in American history. Granted, we haven't been alive for 250 years, but seems like every day is a new adventure with what's going on in the state of the U.S. Yet we got to remember stocks, companies, they are, regardless of what your political views are, regardless of who's in office, regardless of what's going on in the world, people are still getting McDonald's hamburgers or still, drinking Coca-Cola products or Pepsi products. Like literally everything in the snack aisle at the grocery store is owned by Pepsi. Frito-Lay, all those chips and snacks and drinks and everything. Um, People are still buying diapers for their babies regardless. People are watching Netflix. They're talking on iPhones over AT&T and T and Verizon's airwaves. So there's again opportunities for companies to deliver goods and services to individuals and therefore opportunities for investors in those companies to make money in the long run. Can't time the market. Don't try. You're better off just keep buying, investing for the long run. Close your eyes and 30, 40, 50 years from now, it should be drastically higher than it is today. No guarantees, of course, but I mean, just look back in history to what the stock market was, on your birth date versus today, and you'll be astounded at how much it's grown since.
Yep. Time is our best bet, right? Everything else is who knows, a crapshoot, shall we say.
Yep.
Okay. So we had a lot of investing questions just to start today, but another one that I get from a lot of clients is, is it better to make pre-tax contributions into my plan at work or should I be making Roth contributions? So not everyone has both options in their 401k or 403b or whatever retirement plan your employer offers you if your employer offers a retirement plan. But if you do have those two options, it's good to give that some careful consideration. And when you're trying to decide, a couple of things that you can look at. One is what your tax bracket is right now, like your highest marginal income tax bracket. It can be anywhere from like 0% to like almost 37% or something like that. So, whatever you put into a pre tax retirement plan, you don't pay that highest marginal income tax on. If you're also in a state where your income tax is fairly high, that's another consideration depending on where you're at in training or in your career. Like if you're in training and you know you're making less money now than you will likely make as an attending, it can be a good option to make Roth contributions when you know you're paying less tax than you will likely pay in the future. So if we're paying 22% now, but we expect at a full attending income, we're going to be paying 35%. Like maybe it's a good opportunity to make some Roth contributions, which when you make Roth contributions, you're contributing, you've already paid taxes, but when you take the money out down the road, you don't pay taxes on distributions. With the pre-tax contributions, you make contributions now, you get a tax deduction now, but every dollar you take out in retirement is taxable. So these are all the things that we want to be thinking about. So generally, when you're in a fairly low tax bracket, Roth contributions can make a lot of sense. If you're in a pretty high tax bracket, pre-tax contributions become a lot more like attractive to you. The other thing to think about is that Roth contributions take some of the guesswork out of retirement income planning. Like if we're trying to think of how much money we need in retirement, one of the unpredictable pieces is taxes. Like, what are tax rates going to look like when I'm retired? When you have Roth money to pull from in retirement, that's a piece of your income that you don't have to worry about taxes on. So if you just want like some additional security in your retirement income, that can be a good way to build that in. So it's helpful to have some of each, honestly, in retirement, but Roth contributions are more attractive when you pay less taxes, pre-tax when you pay more taxes. Always
Unless
trade offs.
Congress changes the rules on Roth accounts and you do have to pay taxes on that money in retirement, then joke's on
But
you.
no, 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 no. Corey, don't tell people that. You're going to freak them
I'm
out.
just messing
I,
with you. It's
no, no,
unlikely that
no.
that'll happen.
It's possible that they change it. But then again, it's always like, we grandfather in the existing money that's already in these accounts because when people made these contributions, they made them based on this tax planning. And so when Congress has made changes to how retirement plans are taxed and stuff in the future, it's always kind of like moving forward. This is how it works. Right.
Yeah. I'm a big
Yeah.
fan of Roth, like tax-free
Love
money
it.
in the
Me too.
future.
To be
Um,
clear. Yeah.
yes. Jokes aside. Um, Continuing with the jokes, should I be investing in crypto or
We're just calling
whatever
that a joke.
or whatever hot asset class or thing is? Should I invest in gold? Should I invest in art, wine, real estate, whatever? But like I have some friends who made a lot of money, and anytime someone makes a lot of money in doing something, other people are gonna want to hop on and partake in that thing. Short answer is no, you shouldn't be investing in crypto. The long answer is it depends. It's not a business that generates revenue, so very hard to value. It's only worth what someone else is willing to pay for it. I would treat it akin to gambling, invest what you're willing to lose because there's no guarantees it'll go up. It could very well go down. But I'm all for diversifying, throwing some money into it and seeing what happens. It's kind of like precious metals. Like, gold is, some people equate crypto to the modern day gold because gold doesn't have any intrinsic value. It's only worth what people are willing to pay for it. And as long as humans value that shiny gold object, then sure, gold will have some value. But as soon as people stop being interested in gold, it loses value. You kind of see that happening with diamonds right now. More and more people, especially younger folks, are getting lab grown diamonds for their engagement rings or just getting rid of the traditional diamonds altogether. So, diamonds are losing their value as a result. And I haven't followed the diamond market closely. So I don't think like the prices have plummeted by any means, but it's definitely affecting it. So sure, dabble in crypto if you want. Wouldn't recommend it, but I also don't recommend day trading stocks, but it can be kind of fun to throw a couple bucks in there and place some bets on the companies or things that you think might do well. So just don't risk what you can't afford to lose.
Absolutely. Yep. Currencies are always kind of funky. Like, really, they only have value if we think they have value. Yeah. Okay. Moving on from investing, we get a lot of questions about home buying, especially right now. And this is hard because it is a huge topic. We have recorded several episodes on this. So if you're interested in home buying specifically, go listen to a full episode, but just some snippets. We get lots of questions about, should I buy a house or should I keep renting? Should I buy a home now or should I wait for interest rates to come down? How much house can I afford? All of those kinds of questions. And obviously, it will depend on your individual circumstances. But I think if you remember nothing else about home buying from this episode, please remember that it does not always make sense to buy a home. I think there is a common misconception that buying is kind of always better than renting because you're not throwing away money. But that's not true in all scenarios. So be very, very careful when you're thinking about a decision like buying a house because it's a big commitment and you drop a lot of money when you buy a house and you drop a lot of money when you sell a house in the form of like all of the transaction fees that go into that. So, depending on where you live, it can make a big difference. Like, what's the cost of renting versus the cost of buying in this specific area? How is this going to affect my cash flow from month to month? I think it's also really important to consider how long you're going to be living where you're living. Am I going to be here for 3 years? Am I going to be here for 10 years? because the longer you can stay in a home or the longer you want to stay in a home, the more it may pay off to be and like to buy that home. Like you're just spreading out those transaction costs, like the big cost to get into the house, the big cost to get out of the house over a lot more years, which makes it more efficient. Sometimes, not always. Again, run all the numbers for yourself. With interest rates, I think it's really hard to tell exactly where interest rates are going to go from here and how that will affect home prices. So if we want to wait for interest rates to go down, maybe rates go down, but maybe home prices go up because now more people can afford to get into a home. So all of those things kind of interplay. If you can't afford to buy a house right now, then yes, it makes sense to wait. And interest rates going down may not make it more affordable to you. So it may make sense to wait even longer after that. It's not going to be a guarantee that when interest rates go down, a house is going to be more affordable for you. So keep that in mind. The other thing about interest rates is if you get into a home at a fairly high interest rates and then rates do go down, you can potentially refinance into a lower interest rate mortgage at that time. When you like go to buy a home, I feel like banks make that seem like a given. Like, hey, sure, you're going to buy it like 6.5 or 7%, but in like a year, you're going to be able to refinance at like 5.5%. And they treat it like, yes, this is a thing you're going to get to do. Don't assume that. Like, don't buy a house at 7%, assuming that you're going to be able to lower your mortgage rate and your payment in like a year. Like, let's just assume like this is worst case scenario. This is my mortgage. This is how much I have to pay forever. And then if you can refinance, that will obviously make it a lot easier.
I saw a sign outside of a realtor's office, like one of those marquee signs you can change the letters and stuff.
Yeah.
And it said, marry the home, date the rate. And I'm like,
Yeah. That's a saying. That's not
yeah.
even just them. Yeah.
I'm like, if no guarantees that that rate might be married to you as well. You never know.
Yeah. You may be stuck with that rate. Yeah. So obviously, like everyone kind of expected interest rates to go down last year, this year, and they've barely moved. Like inflation has been kind of sticky. So, yeah, we'll see where it goes from there, but just make sure that you can absorb the payment that you have. If you want to wait around for interest rates to come down, you may be waiting a while and the cost may be higher to get into a house at that point.
Well,
In terms
inflation
of like,
has come
yeah,
down, but like the economy has been sticky and awesome. So, I mean, the Fed has no
yeah,
reason to lower rates if the economy's humming. The fear is if they
right,
do lower, it'll spike inflation again. So, like, if we're still
right.
spending like there's no tomorrow as Americans, which we're very good at spending as
Yeah,
Americans, like, why should the Fed give us a discount
right.
if we're willing to pay the price at the current
Yeah, the
prevailing
job
rates?
market's strong. Like we're
Yeah.
good. We're humming. Yeah.
Yeah. So
Okay.
we have stated with our wallets, we are good with these interest rates. No problems
Mm-hmm.
here. We can complain about it, but it's not stopping us.
Yep. How much home you can afford is another one I get a lot, especially in places where homes cost a lot of money. And that purchase price and like what's comfortable will depend a lot on interest rates. So obviously, if rates are lower, we can afford more house. Ideally, like I think the thing that you can look at is kind of run your monthly cash flow and try to keep your home costs, like your mortgage, your like interest, your taxes, your insurance, all that stuff below like 20% of your gross income. And hopefully that leaves you enough room to be able to do the other things, but also look at the other things in your budget. If you have a giant student loan payment every month, maybe that's not doable either. So like more important than anything is not necessarily that purchase price, it's your mortgage payment. Like your mortgage payment is going to have a much bigger interest or influence like on how your financial plan feels and how secure you are from month to month than like the purchase price of the house itself.
And depending on the state, taxes and insurance could be a real thing. Like if you're in
Mm-hmm.
California, Florida, Texas, like yeah, your purchase price and mortgage is one thing, but then when you're hit with another 30 to 40,000 a year in taxes and insurance, it's like, whoa, forgot
Yep.
to budget this
Yeah.
one into the equation. That's an extra
Pencil that
two,
all in.
three, 4 grand a
Absolutely.
month,
Yeah.
not to mention
Pencil that all
maintenance.
in. Keep it below 20%. Yeah, that's a good one to mention just because it varies a lot. If you're moving into a new build, probably going to be okay for a while. Probably not going to have a lot of big maintenance costs. You never know, but probably not. If you're moving into an older home, good grief. You're going to have some fun. There will be things that come up, even if they didn't pop up on the inspection. Yeah.
Yep, yep.
So fun.
Sticking with the real estate theme, should I invest in real estate? Again, getting back to I saw someone make a lot of money in real estate. Should I do the same thing? Our president made a lot of money in real estate. Should I follow his lead? Um, well, it depends, per usual. Do you want to be a landlord? If not, then maybe no. Granted, there's ways to outsource that. You could hire a property management firm if you just don't want to deal with any of the hassles. Because even if you hire a property management company or person, there's still going to be headaches that you have to deal with, or through your property manager deal with. So you could invest in real estate investment trusts, which are REITs, or like limited partnerships where you just give them money and they do all the work and send you the return at the end of the day. You have less control in that scenario, but it's a way to still participate directly in real estate without any of the managerial responsibilities. Um, I mean, I think the big thing is the property going to produce you positive cash flow right now with where home prices are and interest rates. It's really, really hard to find properties where when you look at what the mortgage payment and taxes and insurance and maintenance costs are, it's hard to find ones where you can generate enough rental income to offset or even exceed those costs. If you can, great. What's the catch though? There's probably something up with the property. If it's cash flow positive, and they're willing to sell it to you. But but do your due diligence. I think real estate it's fantastic for some people, a giant headache for others. It's a big risk reward game. You are concentrating and increasing your risk in a single asset versus diversifying across numerous assets. Um, it can work out fantastically or it can fail miserably as a result. Like you invest in an S&P 500 index, 40% of those companies are going to lose money every year. Some will just decrease perpetually, but you're also going to be invested in the winners that carry the index on its back. It's like having LeBron James on your team. No matter who you are, you're going to be competitive, even if it's a bunch of scrubs, because you have the best player on the planet on the roster. Well, that's what investing in an index fund does. You have the best companies on the planet in the portfolio, and it's going to carry all the stragglers with them. Um, a simple example off the top of my head, maybe you find a duplex for 250,000, put 50K down, you're able to rent it for a profit. It's generating positive cash flow. It's appreciating in value over time. Eventually that mortgage is going to be paid off and you won't have that debt. The cash flow will hopefully be able to increase over time as you can raise rents with inflation. That's phenomenal. Sign me up. It could also go the other way. It's a maintenance nightmare. You have squatters as renters that aren't paying their rent. Like it can be a disaster too. So, not for everyone. Do your due diligence and teach their own. It's up to you if you want to explore it further.
Yep. Another question I get is when people are shopping for a new car, should I pay cash or should I take out an auto loan? And that one, oh my gosh, it's so that I'm going to say it depends again. It depends. It always depends. But when you go to buy, it does not hurt to say, hey, what are my financing options? Just talk to the dealership, whoever it is that you're buying from. What are my financing options? If it's a used car, it's probably a loan through a bank. The interest rates are probably going to be super high. So if you can't afford to pay in cash, it probably makes sense. If it's a new car, a lot of times there's like manufacturers' incentives that bring that interest rate down quite a bit, and it can be attractive. It can be 3-4%, which is again way less than we would expect to maybe get long term in the stock market. So maybe it doesn't make sense to put down a large down payment or pay entirely in cash. So the lower the interest rate, the more attractive it is to take out a loan. I think the other thing though is to look at your personal financial profile right now. If you're on track to hit all of your savings goals, like you're doing your long-term savings, you're funding college education exactly how you want to, and all of those things, and you're not really comfortable investing a lot more because you just don't want to put all your eggs in that basket, like that specific investing basket, and you're just sitting on cash. I have lots of clients that are doing that right now. Like, okay, we're saving enough. We don't really want to save more because we're not feeling super great about this. It's like if you're just sitting on cash, you may as well pay for that car in cash. Like it's not bad to not take out debt. We're never going to tell you like you must take out debt. That is the only solution to this problem. But again, you're just going to look at all of the options that you have available to you of what you can do with that money and then make the best decision. So case by case. But again, the lower the interest rate, the more attractive it is to take out a loan.
There we go. How should I pay for this home project or other major expense? And I'm not talking about, we're getting a new refrigerator and it's a couple $1,000s. Should we do the 0% financing option? I mean, maybe, but probably not worth the hassle. Let's pay cash for the couple $1,000 appliance. But I'm talking like the 50 to 100K plus expense. So numerous ways to pay for this. Again, it depends on your circumstances. Do you have the cash on hand? Do you have the ability to pay off a loan in a timely manner? What's the interest rate on the loan? Obviously, cash is easiest if you have it. Bank of mom and dad might be able to help you out too, if that's an option for you at a favorable rate or just a gift. Personal loans, generally not the most attractive right now. For doctors, though, there's a number of lenders that have special rates where they can give you an unsecured personal loan at a reasonable interest rate. Obviously, the lower the interest, the better. You can use your home equity either in the form of a second mortgage, a home equity loan, a home equity line of credit. A big fan of just having a home equity line of credit established, assuming you have equity in your home. You typically need to have the max that they'll typically allow you between your mortgage and any other debt attached to your home is often 80%. Some will go a little higher, but so it's not like you buy a home today with a 20% down payment. You can't also add a HELOC to that. You're going to need to pay down that mortgage and or your home value needs to go up to where your mortgage is like 70% or less of your home value. Then we could potentially open a line of credit on the equity. And, those are typically tied to the prime interest rate. If you think you can pay it back relatively quickly within a year or two, not too bad of a deal. We take out a loan at right now, call it 7.5%, give or take. Pay it off with bonuses or with cash flow over the next year or two. It's a potential option. You could also consider a securities backed line of credit, similar to a home equity line of credit, but it's backed by the value of your brokerage account. So you typically need a decent sized brokerage account for this to work because you can often only borrow about 50% or so of the account value. But if you have a healthy sized brokerage account, similar deal, often tied to the prime interest rate, you can pay it back in a reasonable amount of time, worth considering. Again, you could explore various financing options. Generally not a fan of rating retirement accounts or pulling out of your 401k because there's penalties attached to that. You could do a loan, but then again, money's not growing in the stock market if it's out of the account. So as a last resort, sure. But yeah, this is really one of those case by case basis, probably worth talking to someone like Rachelle and I before pursuing it to figure out what's the
Mm-hmm.
best option for you.
Yep. Obviously, if you have cash, that's the easiest. Okay. This one is so hard, but we are getting so many questions right now about is PSLF going away? Should I be worried about this? For people that still have student loans and are working towards public service loan forgiveness, I think headlines have been kind of scary, honestly. Um, I think for this, we can't predict for sure, but if we look at past like policy proposals and things like that from our prior Trump presidency, I think that is a good way to say, like, what do we think is going to happen moving forward? Again, not guaranteed, but in President Trump's first term, he proposed to do away with PSLF every year in his budget, but it was always for new borrowers only, not for people who already had loans and people who were already working towards building those qualifying payments. And even those proposals did not pass. So as it is right now, PSLF is still here. Every other policy proposals have always suggested that new or like people participating in the program would be grandfathered in. We don't have any reasons to suspect that that would be different, but obviously, like things can change. We just don't expect that they would that drastically. One thing I will say is that it was pretty obviously the goal under President Biden's Department of Education to make it easier to qualify for PSLF, to do things like making sure people can buy back payments when they were on a forbearance, making the payment plans themselves easier. And I think it's reasonable to expect that President Trump's Department of Education, whatever is left of it, will not want to make it easier for people to qualify. So do your best to make sure that you are filing your employment certification, that you're on the proper payment plan. Just cross your T's, dot your I's, do everything that you possibly can to be very thorough with your progress towards PSLF because they're not really going to help you out with that. At least I don't think so.
Yeah, I wouldn't be too concerned though. If you're already in the program, you're
Yeah.
on your way, just keep doing your thing. But yeah, be diligent and make sure you're following all the steps you need to follow to pursue forgiveness. Let's see. Should we look into getting long-term care insurance? Again, it depends, but this is a little for if you're a little older, like most long-term care companies won't issue long-term care policies to people under 40 years old. So if you're 40 or older, then yeah, it could be worth considering. Obviously, the younger you are, with pretty much all health-related insurance policies, health insurance, disability, life insurance, et cetera, it's cheaper and easier to get when you're younger and healthier. Um, if you think you'll need, no one knows for sure if they're going to need care. There's a decent chance you will. Look at your parents, look at your grandparents. Odds are at least one of them was in assisted living at some point. Um, so if you think you might need help paying for the care, not so much if you think you'll need the care, because there's a good chance you'll need it. But if you need help paying for it, then yeah, could be worth considering long-term care. If you don't think you'll need help paying for it, you're a good saver. You're going to have a lot of money. You're probably going to have money left over for an inheritance for your kids or grandkids. Maybe we don't need it. We can self-insure for that risk. I mean, if you need assisted living, you're not traveling to Europe. You're not going skiing. You're not, doing all the fun things. Like you're going to that all-inclusive resort called Shady Acres Retirement Home, and they have 3 meals a day for you, bedding, etc., utilities included, and that's it. Like you're playing video poker and watching reruns of Annie for your entertainment. Um, but even if you can afford to pay for long-term care, you might still want to get insurance just to provide that peace of mind, to leave more of an inheritance for your family. Maybe you have a child with a disability, or your kids just aren't as well off financially as you are, and you want to be able to leave some money behind for them. I mean, that's where maybe getting a permanent life insurance policy could make sense, but also considering long-term care or one of those hybrid deals. You can get life insurance policies that have long-term care riders on them that allow you to tap into the death benefit amount while you're living to pay for that care. And then if you don't need the care, they just get the full death benefit. But if you do need care, they'll get whatever death benefit you signed up for minus how much you spent on the care from that policy. It's a lot of ways to go about it. Again, case by case, if you need it or not. Some of it depends on your financial outlook. A lot of it depends on your financial outlook, I should say.
Mm-hmm. Yep. It's so unpredictable. I think that's one of the harder things to plan for. One that's slightly easier to answer. We get a lot of questions when we talk about like disability or life insurance, and the question is generally like, do I really need this? Do I really need disability insurance? Do I really need life insurance? I think this one's kind of simple. If you need your income, you probably need disability insurance. Like if you are reliant on that and if you don't have that income, it's going to be a challenge for you. Yeah. Hey, you probably need some disability insurance. It's good to look at what you have through work and things like that, but most of the time it's not going to be very comprehensive and it will likely not cover all of your income. So that's where like an individual disability insurance policy can come in super handy. This is another one where it's dependent on your health to get it most of the time. So if you can get it sooner than later, that's a great idea, especially because now is when you're dependent on your income most. Is like earlier in your career is when you really, really need to make sure that you're able to make money for a certain number of years to make sure you're kind of financially stable. At the point where you're like, hey, I could retire tomorrow and I would be totally fine, you probably don't need disability insurance at that point. You have other assets that you can leave on or lean on if you need to. So that's when you can think about maybe canceling that disability insurance or just, not having it anymore. Life insurance is a little bit different because it's not for you, it's for other people. So generally, when you need it is when you have dependents or when you have other people who are financially dependent on your income and your assets. So if someone is going to be in a really tough spot, if your income is not around, life insurance can be really helpful. It's also often inexpensive in terms of like how much coverage you can get. There's something called term life insurance where you secure it for like a set period of time and it has a set benefit and it only costs you like a certain dollar amount per month. So that can be a good inexpensive one to look into. When we're thinking about like when do I not need life insurance, it's usually when you have enough other assets to leave behind that the people who are financially dependent on you would be okay. So when we have our mortgage paid down entirely and we have significant retirement assets and we know that we can leave those behind to our dependents, then we probably don't need life insurance anymore. So again, it all depends on your individual circumstances. So it's really important to look and say, am I dependent on my income? Are other people dependent on my income? What does that look like if I'm not around or I'm not earning money anymore? And can I share this risk with an insurance company? Because that's what they're there for.
Yep, yep. Yeah, I mean, the easy question with any insurance, if this event happens, would it cause financial problems for me or my family? If the answer is yes, it will cause problems, then probably should get the insurance. Let's see. Last one here. We could quickly touch on it. Oh, you deleted it. You want to go?
I deleted it. I don't
Now
want
that
to
we
talk about it.
teased it.
Oh, fine.
All right,
Yeah,
I'll
I
make
did
it
write
quick.
another one. Yeah,
So,
you do it.
is it better to be a W-2 employee or a 1099 independent contractor? And most of you don't have an option with this. Like if you're employed by a hospital, university, a large multi-specialty group, you're going to be a W-2 employee. No negotiating there. But if you're at a smaller private practice or, doing locums or just, starting your own practice, want to be
Or
self-employed.
just looking for a new job, you know?
Yeah.
Yeah.
You could potentially be an independent contractor where you're not, employed by an institution. You're just contracting and providing services for them at will. But it could, pretty much end at any time. Benefits to both. Obviously, the W-2, you're going to have a salary for a set number of months or years. Most likely, there's going to be a defined pay structure, most likely benefits included, health coverage, etc., retirement plans. If you're a 1099 independent contractor, there are no benefits. There is no guaranteed salary. It's kind of an eat what you kill model if you're.
And you probably pay more taxes.
Yeah, because you're going to have to pay the employer side of the FICA taxes, the employer portion of Social Security and Medicare. Uh, that being said, you can write more stuff off. You can deduct more as an independent contractor, run expenses through your contractor income, or if you set up a LLC or S corp or something for yourself, run it through that. Retirement planning is awesome as a independent contractor. Like from that standpoint alone, you can save a ton of money in a tax favorable manner as an independent contractor. Like I have some clients saving well over $100,000 a year pre-tax for retirement, just because they're self-employed. So some pretty cool stuff you can do as an independent contractor, but you have no benefits, you have no guaranteed work. You're self-employed. So pros and cons.
Yep. Generally, I like to tell people that if they can make a good chunk more money by not being a W-2 employee for the same amount of work, it's probably worth considering. A little riskier, but
You
worth
might have
considering.
more control over your schedule too, which is
Oh,
cool.
for sure.
Like if you're doing
Oh, absolutely.
locums, you decide when and where you want to work. Like if you want to
Hmm.
pick up that gig or not. Now, when
Yep.
you're working, but I have some clients who do locums, they, maybe work half the year, not like 6 months on, 6 months off, but it's like 1 or 2 weeks a month, and then, take 1 or 2 weeks a month off. But, when they're working, it's like 7 days on. So
Hmm. Yep, absolutely. Well, thank you for listening, everyone. If you have any other like burning questions, let us know.
adios. See you later.